morning. So, in the previous class we discussed about the importance, functions and the regulations of the commercial bank. Then before we going to discuss about before we start the discussion on the different aspects of the management of assets and liabilities, let us understand something related to the how the asset and liabilities of the commercial bank looks like, or what are those items comes under these assets and liabilities, and how the performance of the commercial banks are measured. Then after that we can move towards the risk management and the other aspects of the commercial banking. So, today I will be discussing about the financial statements of the commercial bank. So, you might have the idea about the financial statements, that whenever in general we talk about a financial statement, we generally always come across three things. One is your balance sheet, and second one is we come across the income statement, and third thing is the cash flow. And here whenever you talk about the cash flows are basically derived from the different sources. One is your operating cash flow, financing cash flow, investment cash flow and all these things. But whenever you talk about the commercial banks, or we analyze the financial statements of the commercial banks, we mostly focus on the balance sheet and the income statement. So, in today's discussion, particularly for this session, we will start with the balance sheet, and then we can move towards the different type of assets which are comes under this balance sheet. And out of them there are one of the major asset what the commercial bank has, that is the bank lending, and there are different approaches the commercial bank follows for providing the loans, or there are some theoretical philosophy involved in that. So, what exactly that approaches are, or how these different approaches are used for bank lending by the commercial bank. So, that is basically our next discussion. So, these are the three different motives or the three different issues what we will be discussing today. We will define balance sheet, we will discuss about the different assets of the commercial banks which comes under this balance sheet, and the approaches what the commercial banks follow for the lending purpose. So, these are the different concepts or different issues what basically we are going to discuss today. So, already you must have the fair idea about the balance sheet, what exactly the balance sheet is. Whenever you talk about the balance sheet, whether it is a commercial bank or whether any other financial institutions, or it may be a company, but whenever we discuss or we analyze the balance sheet is defined basically, or balance sheet basically shows the financial position of the company or financial position of the bank at a given point of time, usually the last day of the quarter or the year. So, you might have heard that whenever we try to see that what is the financial condition of a particular organization, we see that you might have seen that people generally write the as on 31st March 2019, what is the financial position of the company or financial position of the bank. So, therefore, the balance sheet basically provides the condition or the situation of the commercial bank at a particular point of time. So, whenever you talk about financial position, it talks about the assets, liabilities, the capitals, all type of things which comes under the financial statements. These are reported in a balance sheet, and that balance sheet gives you the idea of the financial position of the company on a particular time or a particular date. So, sometimes also the balance sheet is viewed as a list of financial inputs, that means the sources of the funds, and the outputs, that means the uses of the funds at a point of time. Then from where the money is coming and where the money is going and how the money is utilized. So, these are this is the way also the financial statement, particularly the balance sheet, can be looked upon. So, one is two things basically we keep in the mind. One thing is the condition of the company is shown at a particular point of time through the balance sheet, and balance sheet is also can be judged where the cash flow or the financial inputs and outputs or the sources and uses of the funds of a particular organization. So, balance sheet basically is viewed as a list of financial inputs and outputs at a particular point of time. The point of time is very important in this particular context, because we are not basically considering what is happening to that particular bank or particular organization over a period of time. We are basically judging this performance at a particular point of time. Basically, it is at a particular point of date. So, this is the basic definition of the balance sheet. Then in the balance sheet, we have two things, we have assets and liabilities. So, in this particular session, we will be discussing about the different assets of the commercial bank. Then we can move towards the liabilities, and finally, we will discuss about the income statements or the profit loss account of the commercial banks. So, now we talk about the assets of the commercial bank. There are many types of assets the commercial bank has. The first one is the cash, what the commercial bank has, how much cash they are holding. There are many sources that we will discuss. Second most important aspect of the commercial bank in terms of assets are the investments or the securities what they are holding. There are many sources of securities holdings. There are many sources the securities can be brought into the commercial bank or can be brought in or may be used by the commercial banks, and there are many investment alternatives which are available in the financial system, where the banks basically use those investments alternatives for their investment to maximize their profit or the return. And another most important asset is loans, because the loan is the liability of the customer or the clients or the individuals. For the bank, the loan is basically one asset from where the bank generate the maximum revenue, because the whenever the bank gives the loan, against the loan they charge certain interest, and that basically interest income is the major source of income for the commercial bank. And there are some miscellaneous assets. Miscellaneous asset includes the fixed assets, it includes the intangible assets and all these things what the commercial banks hold. So, there are four broad categories in terms of the assets of the commercial bank. Then we will see that how those particular assets are defined and which are those different components which comes under the different broad classification of these assets. So, now we talk about the cash. The cash is basically what? There are some cash which is already the banks hold. So, the particular cash which includes the cash in treasury or the vault cash, already the cash is there in the commercial banks. Maybe there is a surplus which is available to the commercial bank, or the commercial bank hold those cash for some specific purpose. So, the already whatever cash is there, that is the first part of the cash asset. Then they have a deposits with other banks, small the maturity period is very short, but they keep these particular deposits with other banks. And there are some cases the cash in the process of collection, the bank is not yet is not receiving that particular cash or has not received the cash immediately, already it is not there with the banks, but that is in the procession. Maybe in the process basically the collection is there. So, the collection can be made in the near future or a very short span of time. So, the cash process in process of collection also consider as a asset for this, and the commercial banks also keep certain reserves with the central bank. So, the central bank they have some kind of deposits they make with the central bank, and against that they get certain amount of interest. So, that is why the cash and deposits due from the banks, these are there are many, these are the many sources through which this particular item comes to the commercial bank. And if you combine all these three, all these three basically or all these four, it is basically called as the primary reserves. The primary reserves means it is the reserves which is there or which is available to all the commercial banks which are operating in the economic system or in the financial system. So, these are basically called as the primary reserve, and these are highly liquid and short term in nature. Then the second type of assets we have, that is securities or the investments. You know, whenever the commercial banks invest their money, where the money is invested. Whenever they talk about the investment in the different type of assets, the assets are classified into two. One is your short term assets, and another one is the long term assets. So, there are two different broad categories of the assets, and the short term assets are basically highly liquid and the long term assets are not that much liquid, but the banks basically hold both type of assets for their investments, because the requirements of the banks are different. So, to fulfill that requirements, they basically keep the both categories of the assets into their portfolio or into their balance sheet. So, whenever we talk about the short term securities, the investments in the short term securities, these are considered as the secondary reserves of the commercial banks, because the primary reserves are highly liquid. These are highly short term in nature, which includes cash, the current account deposits with the reserve bank and all. And then we have another type of securities, which is short term securities, where the banks invest their money in a very short term instrument which are available in the system. So, these are basically considered as the secondary reserves. What are those different sources? The different sources are short term government securities. The short term government securities, particularly the treasury bills we have. Then we have also the instruments like the treasury bills are issued by the government. So, that is why whenever we talk about the government securities, we consider treasury bills is the one of the investment alternatives through which the commercial banks invest their money in the short term instrument. Then we have the interest bearing time deposits, which is a money market instrument. The period is very small, below 1 year. So, here we are referring to the maturity period of those kind of assets are up to 1 year time. And we have the commercial papers. The commercial papers are issued by the another bank or different type of banks. So, if the commercial papers are issued through which also the commercial banks invest their money or they raise the money for a short term purpose. So, these are basically the money market securities. We have the interest bearing time deposits, then we have the commercial papers. Then whenever you talk about the long term investments, the long term investment alternatives, either the commercial banks can invest their money in the government dated securities. In India, we have a very developed government securities market, particularly the government bond market. So, there the maximum term to maturity is up to 30 years. The 30 years is the term to maturity in the government securities market. So, because of that, what basically here we can say that the banks also can invest in the dated securities whose maturity period is relatively large, and they can extract some kind of return out of this by reading the yield curve in a better way. Then we have debentures or the corporate bonds. These are issued by the different corporates. Bank can also invest their money into that, and these are also very long term instruments which are available for the banks for the investment. So, we have two things, we have government dated securities and we have corporate bonds, and government dated securities are issued through the auction process. The bank basically does this, or the Reserve Bank issues this particular securities through auction process, and the commercial banks participate in that auction process, and through that they invest in that particular securities. So, we have two types of auctions, we have a price based auction, we have a yield based auction, but whenever the first time securities comes to the market, we have to use this yield based auction, and generally this commercial banks always try to invest their money in this particular securities, or the Reserve Bank of India sometimes control this money supply in the monetary policy process through this use of these government dated securities or by selling the or buying the bonds into the open markets, which is popularly known as the open market operation. But for commercial bank point of view, this is one of the major instruments where the commercial banks basically put their money. So, government securities is one of the better alternatives for the long term investments by the commercial banks. Then we have the corporate bonds, already I told you these are also called the debentures, and some of the assets are basically we can say that senior and some of the assets are junior, and here some of the assets are secured and some of the assets are unsecured. So, whenever you talk about the secured asset, that means the assets are backed by any kind of securities, but whenever you talk about the assets which are not backed by any kind of securities, these are the unsecured assets, or those assets investing in those assets is relatively risky. But still those are the different alternatives which are available for investments by the commercial bank, which is considered as one of the most important items in the balance sheet or the asset side of the balance sheets. So, this is what about the investment. Then we can move towards the other type of investment what the commercial banks do. Another one is commercial banks can invest also in the stock market or in the equity. That is why they have a trading account, and securities purchased in this particular channel to provide the certain profits from certain price movements because of the market fluctuations, because of the demand and supply forces of the security. The particular stock issued by the raised by this particular bank can fluctuate. So, the commercial banks can take that advantage due to the certain price fluctuations. They try to extract maximum revenue or maximum return out of this, and these are basically valued in the market. So, in this particular case or this item, the value of this particular asset is changing frequently on the basis of the market price of the stock of that particular bank. So, that is why in overall what we can say, the commercial banks also invest the money in the equity market through their trading account, and those particular value of those assets are changing or maybe always subject to the fluctuations of the market. So, on the basis of the demand and supply, the value changes or the stock price of the bank changes. If the stock price of the bank changes, then automatically what happens that the value of the total assets under this category also changes. Then we have the some reverse repurchase agreement. Sometimes the central bank can park their money with the commercial banks, and against that they provide certain interest. In our context, we call it the reverse repo, and these are very short term in nature, generally for the overnight. And if there is any point of time, whatever the government funds the particular commercial bank is holding, they can also sell that particular fund, and that is why these funds come from the deposits at the central bank. And as well as already I told you about the reverse repo, which is basically the money which is kept by the Reserve Bank of India or any central bank with this commercial banks to park that particular money, and once the money is parked with the central bank with the commercial bank by the central bank, then also they get certain revenue out of this. So, that is why that is considered as an asset for the commercial bank. Then the most important asset or most important item in the asset side is the loan or the advances. Whatever advances the commercial banks give to the customers in the different forms. So, this basically is the major source of revenue. This is a major source of income for the commercial banks in the market. So, whenever you talk about this, there are different type of loans the commercial banks provide. The loans can be industrial loan or the commercial loan. The loan can be also consumer loans, and loan can be given to the different companies for a particular purpose. For example, real estate loans, particularly buying the house and all these things. Then the loans also can be given to the other banks or financial institutions which are existing in the system. And also the another question is that the loans are also given to the priority sector. Priority sector means we are talking about the rural sector like agriculture, small scale industries, or small loans which are given for the betterment of the society at a large, and these loans are given with a huge discount, or the interest rate against this particular loans are relatively very small in comparison to the loans given to the industry or any kind of loans given for a commercial setup or any other consumer loans like your education loan, it may be the personal loan or it may be any kind of vehicle loan and all these things. So, these are different kind of loan accounts for the commercial banks hold, and the loan is basically the major source of revenue for the commercial banks, because against that they generate certain interest income and they try to maximize their revenue through this particular loan. Although there are many issues involved in this particular loan, many assets are becoming non-performing or the loans are not repaid and all these things, but still the whole banking system relies more on these loan activities. That is why the loans are considered as the most important source of assets for the commercial banks. So, we will be discussing in detail whenever we talk about the management of the loans by the commercial bank in the future sessions, and there we will be discussing that how the loans are given, whether the loan giving procedure is same for the retail loans or and the commercial loans or the industrial loans, or there are different processes or different kind of strategy the banks follow whenever they provide the different loans to the market, or the loans are given for the different purposes. So, these are the things what we will be discussing in detail, but these are the major type of loans what the banks have, and it is considered as the asset because banks generate the revenue through their through this particular loans, because they extract certain kind of interest payments for that. So, this is basically about the different type of loans which are available. But whenever the loans are given to the commercial banks, you know, commercial banks give different type of loans. You have housing loan, you have industrial loan, you have the vehicle loan, you have the personal loan, you have educational loan. There are many types of loans are given, but whatever loan it may be, whenever the commercial banks give loan, the loan giving process based upon certain kind of philosophy, or what is the philosophy of giving these loans and what kind of approach the commercial banks follow whenever the loans are given to the different kind of clients. So, whenever we talk about that, we can summarize that, or we can say that there are two approaches the banks may follow whenever they provide the loans. And what are those approaches? Then one approach they call it the liquidation approach, and second one is the going concern approach. What do you mean by this liquidation approach? The liquidation approach is whenever the commercial bank give the loans are basically always given on the basis of a collateral. That means, the loan should be backed by any kind of asset. So, the asset can be anything, the asset can be fixed asset, or the asset can be also the stocks, bonds, etc., etc., or the asset can be gold, or the asset can be land, asset can be house. So, there are different type of assets, although the margins vary across these assets. That means, what do you mean by the margin? For example, whenever this is the way the margin is defined. The margin is basically what? Let the bank wants to give a loan of 1 lakh. If the bank wants to give a loan of 1 lakh, or you want a loan of 1 lakh, then bank will take one particular asset as a mortgage or as a collateral against this particular loan, whose value is more than 1 lakh. More than 1 lakh. What is the reason? The reason is that there is a chance of depreciation, or there is a chance of appreciation of that asset. But for the safer side, bank always keep one particular asset whose value is more than the loan demand what the customer is making. So, that is basically margin, and that margin account or the margin value varies across the different type of assets. So, if it is a gold, then the margin is different. If it is a stocks or bond, then margin is different. If it is a certificate, the margin is different. If it is a government securities, then the margin is different. So, on the basis of riskiness of that particular asset or the fluctuations of the value of that particular asset, your margin amount varies. So, that is why the loans which are given, these are basically given on the basis of the asset which is the customer is giving, or with the asset which is used as a collateral against this particular loan. So, if there is any default, then the commercial bank can liquidate that asset and get back the loan. But this particular approach, mostly the India and commercial banks follow this kind of approach. So, whenever any commercial bank follows a liquidation approach, so that means they always look at the short term view of the borrower's point of view, borrower's prospects. The long term prospects of the borrower is not considered. How that borrower is going to perform in the future, or whether really this potential of the borrower will change in the future, that is not basically judged by the commercial banks, or that is not considered by the commercial bank. They see the current position, and accordingly what kind of asset the borrower is giving, they decide on that basis. The loan is decided on that basis. But whenever we talk about the going concern approach, so here the bank basically gives the emphasis on the ability to repay of the loan, which based upon the future cash flow of this particular customer or this particular loan, instead of any kind of tangible assets. So, what does it mean? That means, if the bank feels that this person is able to repay this particular loan in a particular period of time, because he or she is able to generate revenue periodically, and that ability basically convince the, or is helping the banks to be convinced that okay, this person is able to pay the loan in the future. So, that is why that is called the going concern approach, and most developed countries, US and other countries, they follow this going concern approach whenever they provide the loans. Then we have some other assets. We have some specific reserves also sometimes bank keep for a particular loan. It is not the general reserve what they keep against all the loans. For some specific loans, sometimes the banks keep some reserves, that is called the specific reserves, and remaining reserves whatever the banks keep, that is called the general reserves. And mostly the reserves also sometimes determined by the management of the commercial bank, the taxes and the government regulations. Government regulation, tax and management, these are the responsible factor for this kind of reserves what the commercial banks keep. Other assets, obviously they have the fixed assets, they have the building, they have the land, they have the machines, they have all kind of computers and other things, these are considered as the fixed asset. They can also invest the money in whether directly or indirectly in the real estate. The commercial banks do sometimes also that kind of business. So, that also comes under the asset. And another thing today's context is important is the goodwill or the reputation of the commercial bank and the other intangibles what the commercial banks are holding. So, that also affects the market value of the commercial bank. So, once the market value of the commercial bank changes, it will have a larger impact on the performance part. So, goodwill and other intangibles also considered as the important assets of the commercial banks, which are relatively subjective in nature. So, considering these things, what basically we have discussed that the balance sheet represents the financial position of a commercial bank at a particular point of time, loans, investment, cash, then you have the reserves, these are the major assets of the commercial banks, and there are two approaches the commercial bank always follow whenever they provide the loans. These are the liquidation approach and the going concern approach, and liquidation approach is the short term approach, or the look at the short term perspective of the borrower, and the going concern approach believes in the long term perspective of the borrower. So, these are the issues what basically always we look at across the globe whenever the bank's assets are analyzed. So, these are the references you can go through for the detailed discussion, and thank you.